Welcome all to FSA Learning Module 3, some EOC cues on the world of balance sheets. All of the following are current assets except, so which is not a current asset? Cash certainly is. Goodwill, no. Goodwill, we looked at in the module, is a long-term asset. Arises on the acquisition of another company, sits in long-term, so that's not. Inventories certainly is. That's B. The initial measurement of goodwill is most likely affected by. So let's think of how we measure goodwill. It arises on the purchase of another entity. We'll need the purchase price, and we'll compare that purchase price to the fair value of the target's assets and liabilities. Let's tie that back into the three options. Most likely affected by the acquisition's purchase price, definitely. B, the acquired company's book value. Nope, it's fair value that we need, not book. The fair value of the acquirer's assets and liabilities. Certainly we need the fair value of assets and liabilities, but of the target, not the acquirer. That's what makes C wrong. This is A. 4. Financial assets classified as trading securities. How are unrealized gains and losses reflected in shareholders' equity? We're looking at trading. That's the US GAAP terminology. IFRS would call that, and the reason they used US is because the IFRS terminology kind of gives it away. IFRS would call that fair value through profit and loss. It kind of tells you what's happening. Unrealized gains and losses, what we mean by that is changes in value. If you had a financial asset, let's say a bond, and it was paying a coupon, the coupon is a realized gain as a result of holding the asset. That goes through the income statement regardless. Changes in value do depend on how you classify. Here it's trading, fair value through P&L, so yes, they are recognized. A is wrong. They flow through income into retained earnings. Absolutely. They are a component of accumulated OCI, other comprehensive income. No, for trading it is B. They go through the income statement. For financial assets classified as available for sale. US terminology is available for sale. If we were in the land of IFRS, this question would be a giveaway because IFRS describes exactly what happens. The equivalent IFRS is fair value through OCI. So unrealized gains. This tells you immediately that we are recognizing the unrealized gains because unrealized gains are changes in value. Any treatment where we're putting these financial assets on the balance sheet at fair value tells you we are recognizing changes in value because every year we'll update that fair value. Where do they go? Through OCI. So not through retained earnings, they go through OCI. That has to be C. 4. Financial assets classified as HTM, held to maturity. US GAAP term, held to maturity. IFRS, they would tell us the answer effectively because they describe these as financial assets that are measured at amortized cost. What does that mean? Well, if you have an unrealized gain, that is the change in value. It's not the coupons you receive from bonds. It is the change in the market value. And if we are putting on, or rather putting the asset onto the balance sheet at amortized cost, we are ignoring the fair value. So unrealized gains, changes in value, quite simply, are not recognized for HTM. Has to be A. A company has total liabilities of 35 million Great British pounds and total stockholders' equity of 55 million. So we have total liabilities, we have total equity. Total liabilities are represented on a vertical common size balance sheet by a percentage closest to. How do we put together a vertical common size balance sheet? Well, every line item is expressed as a percentage of total assets. We don't have total assets, but what we have are liabilities and equity. We can use the gift of the accounting equation. Assets equals liabilities plus equity. Assets minus liabilities is equity. Express it how you like, but this is what we need. Assets is going to be the 35 million liabilities plus the 55 million of equity. That's 90 million. Total liability percentage then, total liabilities were 35. 35 divided by 90. That gives you, with a bit of rounding, 39%. We're looking at B. Which of the following would an analyst most likely be able to determine from a common size analysis of a company's balance sheet over several periods? So common size analysis of the balance sheet, we will express each line item as a percentage of total assets. So we can see how each category is moving either over time, or we can just, as a cross-sectional analysis, compare it to our peers. What would it allow us to do? Look at an increase or decrease in sales? We're on the balance sheet, sir. That's not going to work. An increase or decrease in financial leverage. To calculate financial leverage, we would need debt. We would need equity, maybe total assets. All balance sheet items. Certainly, I think we could do that. So I'm going for B. A more efficient or less efficient use of assets. Certainly, assets are on the balance sheet. But efficiency, we'd need to know what those assets were generating. So we'd need some sort of revenue figure or a profit figure, something like that, which we don't have. So we couldn't get all the way to C. It has to be B. Defining total asset turnover as revenue divided by average total assets. Okay, I knew that, but thanks for telling me. All else equal, impairment write-downs of long-lived assets owned by a company will most likely result in an increase for that company in the debt to equity ratio, but not the total asset turnover. So there's two ratios we're looking at here. Debt to equity, they didn't explain that what that was, because clue really is in the name, debt over equity. So an increase in debt to equity, not total asset turnover. So essentially we just need to work out here what's happening to each of those ratios. First thing to do in a ratio question like this, make sure you know what the transaction is. It is a write-down of long-lived assets. What's going to happen? My assets are impaired. They're dropping in value. So assets will decrease. But we are in the world of accounting. There is always another side to it. There is always an equal and opposite effect. So if assets are dropping, what happens to that write-down? It gets charged to the income statement. So you'll have an impairment expense in the income statement, which means net income will be reduced, which means retained earnings will be reduced, which means equity will be reduced. Check the accounting equation still balances. Assets minus liabilities equals equity. We have reduced equity and we have reduced assets. That still works, convinces me I've got it right, or at least a feasible transaction. Now let's see what's happened to the elements of these ratios. Revenue has not been touched. Average total assets has come down. Well, in this ratio, not touch the numerator. The denominator has reduced. That's going to increase the ratio. So increase in the total asset turnover is right. Not the total asset turnover. A is wrong. In the debt to equity ratio, we have not touched debt. Equity has decreased. So once again, nothing in the numerator, but denominator decreased. Also increases. So increase in the debt to equity ratio, we rolled that out. Total asset turnover, not. No, that's wrong. See, both of them, absolutely. This is C. An investor concerned about a company's ability to meet its near-term obligations, so we're talking liquidity here, is most likely to calculate the current ratio. Yeah, I'd do that. Return on total capital, no, that's more of a profitability concern, not meeting your obligations. Financial leverage, that's solvency. That's long-term. If we're concerned with short-term, we are looking at the current ratio. It's A. The most stringent test of a company's liquidity is cash quick or current. Well, as we go this way from C to B to A, we are getting more stringent. We get more stringent because we're including fewer current assets in that numerator. Current ratio will have all current assets on the top, current liabilities on the bottom. Quick ratio, we remove inventories and anything else that might be kicking around that isn't cash, marketable securities, and receivables. For the cash ratio, cash, marketable securities. That's what we include. So we're getting more stringent as we go up those options, and we end up at A with the most stringent. Often called a crisis measure, the cash ratio. An investor worried about a company's long-term solvency would most likely examine its current ratio or no. That is short-term. All about liquidity. Can you meet your near-term obligations? Return on equity is more of a profitability measure. You can have a decent return on equity and still have solvency problems. Debt to equity, yes, that is your long-term solvency. The classic. Debt to equity, answer has to be C. Now then, 4 questions here grouped around one big balance sheet. You would not get this in the exam in level 1, but it's a good way of just giving you some data and getting you to play around with it as practice. Let's start at the top. Consider the common size balance sheets in Exhibit 1 for Company A, Company B, as well as the industry average. So we have A in the average, yep. Which statement is correct? Company A has below average liquidity risk. That would annoy me in the exam, quite frankly, because I have 3 liquidity measures, the cash ratio, the quick ratio, and the current ratio. Do they want me to calculate all 3 for A, all 3 for B, all 3 for the industry and see if there's a common theme? Because quite frankly, I can't be bothered. B, Company B has above average solvency risk. Same concern. Solvency, do I go for debt to equity, long-term debt to equity, debt to debt plus equity, financial leverage? This is a lot of work. C, Company A has made 1 or more acquisitions. How could you spot if a company has made acquisitions on the balance sheet? Well, a telltale sign that we talked about in the module, what does a company potentially create, and to be honest, 99% of the time create, if there is an acquisition? Goodwill. If you've made an acquisition, you are likely to see goodwill on the balance sheet. So let's go to Company A. Goodwill is a long-term asset, so don't care about current. There you go. There's goodwill. Kaboom. Company A has goodwill. The only way you can get it is by making acquisitions. That first answer is C. I would rather do it that way than go through and calculate all of these ratios. Obviously, you have the balance sheet available. You know the formula for the ratios. Go nuts and practice. But the answer to that one has to be C. And besides, they make us calculate some of these ratios as practice in the next couple anyway. Starting with the quick ratio for Company A. quick ratio, we're talking the world of current assets compared to the world of current liabilities. All of my liquidity ratios use total current liabilities, so the denominator is easy, 35, 25, or 28. In the numerator, if it's the quick ratio, I am using cash, marketable securities, and accounts receivable. I am not including inventories or prepaid expenses. So for company A, I'm going to have cash, marketable securities, and accounts receivable over total current liabilities of 35. That will give me 0.43, which is A. Next up, the financial leverage ratio for company B. The financial leverage ratio, total assets divided by total equity. You'll recognize that from the world of DuPont analysis when we broke down ROE. How is a measure, or rather, how is it a measure of leverage? Well, the difference between assets and equity, liabilities. So it is essentially measuring how much of your asset base, your total assets, is funded by equity and how much is funded by liabilities. It's for company B. So let's take a look. Total assets. That's handy. Nice, easy calculation. 100. Equity. Now we've got total liabilities and equity down here. Total equity is 45. 100 divided by 45, 2, 2, 2, a rather precise looking C. And finally for these four, which ratio indicates lower liquidity risk for company A compared with company B? Cash, quick, or current. So we are going to have to blast through all three of these for both A and B. So let's do it. Cash ratio, remember, is the most stringent. It includes only cash and marketable securities. So for company A, that's going to be 10, just the cash and the marketable, over current liabilities. We used this before, 35. 0.29. For B, cash, marketable securities, just the 5 of cash. Current liabilities, a total of 25, 5 over 25. That's 0.2. What are we looking for in the question? Which ratio indicates lower liquidity risk for A compared with B? Well, a lower liquidity risk means higher liquidity, which means a higher ratio for A. 0.29 is higher than 0.2. The answer is A, the cash ratio. Just for completeness, being as we skipped out and doing a lot here, let's just calculate the other two. The quick ratio, we've already done that for company A. It was 0.43. For company B, the quick ratio, we'd include accounts receivable. So 20 over 25. 0.8. So yep, B is wrong. And the current ratio, everything. All current assets, so 35 over 35. Liabilities for A, that would be 1. And for B, 48 over 20. Oh no, sorry, wrong column. 55 over 25 for B, 2.2. Again, that's greater, so yep, C is wrong. It is indeed A.